Hello and welcome to episode 445 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leaks. Damien, welcome back. How are you doing?
I'm good. This part of the show, I normally tell you something either that I've been doing or about Money to the Masses, but I've got nothing. I've got nothing. So we've just been on the same grind, doing the same money stuff. New year, always busy. So unfortunately, Andy, I've not really done anything. I think it's just been a case of staying indoors, away from the cold, and just cracking on.
Do you know what? I think the listeners will appreciate that, because I'm guessing it's the same for our listeners too. And they're tuning in this week to get some nuggets from you in terms of finance. They don't want to hear what's going on in our lives. They just want to...
I think they secretly love it, to be honest with you. We do have people write in and do reference it in their reviews, which always does make me laugh. And on that note, don't forget to send in a review via any podcast app that you use, but also don't forget that you can now write comments on the YouTube versions of these shows. So this show goes out as a podcast on YouTube, and people are starting to write comments on there, and I go on there and reply to them, even if it's just to say hello or that you enjoy the show. Don't forget, go onto YouTube's podcast section, find Money to the Masses, and you can write anything on there, questions, whatever, and we will respond. But also, we are now starting to produce more of this content as a show on YouTube, so you can see us performing, for want of a better word, the show itself. So go and watch that, because we are trying to put more of that up on our channel, and also subscribe to our YouTube channel, because that helps as well.
Yeah, and if you interact with the show and you pop something on the YouTube comments on the video and stuff like that, then you could get yourself a Money to the Masses mug. We do like to give out Money to the Masses mugs for anything that we call mug worthy. So reviewing the show is obviously the primary thing that we like people to do. So do go onto your podcast app of choice and rate it 5 stars and tell us what you liked about the show. Get in touch with us and we'll send out a Money to the Masses mug. That's how it works. Right, should we crack on with what's coming up on this week?
Yeah, so what's on the show this week? There are 3 pieces as usual. Now, the first piece I want to do is in relation to taxation of interest on savings accounts. So there are more and more people that will be having to pay tax on their savings, and it's particularly relevant because we're heading towards the deadline for submitting tax returns. So there will be more people potentially who are needing to submit tax returns in relation to the tax on their interest, because interest rates are higher than they have been historically. So more people are earning more interest. The next piece I'm going to be doing is in relation to something we did last week, New Year theme. So I'm not doing an investment piece this week. Again, I'm going to keep on this theme of people trying to start afresh, try and take control of their finances. And last week we were talking about making small changes and how they can compound. But one of the things I want to do is talk about reviewing the past. I'm going to do a piece on that. And Andy, finally, you're going to be talking about national insurance.
Yeah, that's right. There's been a cut to national insurance on the 6th of January. So I'm going to do a short piece just explaining exactly what that means, how much people are potentially going to save, how much they're going to have extra in their take-home pay. And that's whether you are self-employed or employed, because there are additional changes to national insurance which are coming up for the self-employed as of the 6th of April. So we'll go through those details, but also just to finish off the piece, we came up with some ideas on actually how you could use that money if you kind of don't need it, if you like. So what you could do with the extra money, some ideas there.
Yeah, so we've touched upon the cuts before when they were announced, but this is really going to be talking about what's the implications for your finances in a positive way, what you could do with that extra money. So let's kick straight on with the first piece. Now, I'm going to be talking about taxation of interest that you get on your savings account. So just to give a bit of a recap, when you get interest on your savings, that is actually paid to you gross. Now, if you go back many years, it used to be taxed at the basic rate. So you used to get interest on your savings that was actually 80% of what you were given, if that makes sense. So the net amount, it was taken off the effectively 20%.
So all interest you were earning ultimately was paid to you net, irrespective of how much interest you were getting. It was just, that was the default.
Yeah, it's net of the basic rate of tax, which I think back then was actually still 20%. So the reason I mention that as well, it's got a nice circular link with the beginnings of Money to the Masses. So when Money to the Masses was first created, the first ever article I wrote on Money to the Masses was to do with something called the R85 form. And it was a form that you could fill out, and give to your bank that enabled you to receive your interest gross. And it was one of the tips that people didn't realize you could do that. And so for some people that made a lot of sense. So that was the first ever article. And so for many years until fairly recently, it was still relevant to people. So anyway, that's a nice sort of trip down memory lane.
I wonder if we've still got that article in the site and whether I should link to that, or is it best left in the past? It won't obviously be relevant.
Style-wise, it's very different, but it does exist, and it will always exist because I think it's just one of those nice throwbacks to where we've come from. And now interest is paid gross, so we don't have to worry about the R85 form. But there comes a point where you will indeed end up paying tax. Now, just to give people a summary of what happens with tax, you have 3 allowances that can be applied to the interest that you earn. So interest on your savings, you can use your personal allowance. Everybody has a personal allowance. Typically that's £12,570 every tax year. That's if it hasn't been adjusted in any way. And on top of that, you then have something called the starting rate for savings. This is the one that most people don't know about. So you can earn up to £5,000 tax-free, so additional amount of interest a year. So the way this works is that you can earn up to £5,000, but for every pound that you earn over your personal allowance, that £5,000 allowance is reduced. So if you get to £17,570, so we're talking about, let's say you have pension earnings or wages that are more than your personal allowance, and in fact you get to £17,570, then what will happen is you don't get that starting rate of for savings. So you just have the normal personal allowance. So that's why most people don't know about it, because most people don't get it. Now, on top of that, you also have the personal savings allowance. So that's the £1,000 allowance. So the £1,000 in interest that you're allowed to earn each year without paying tax if you're a basic rate taxpayer. So that's if you're a 20% taxpayer. And the band for that is you need to earn less than £50,270, but obviously more than the personal allowance of £12,570. So if you're in between that, you pay 20%. You have a personal savings allowance of £1,000 a year. If you are a 40% taxpayer, then that allowance drops to £500 a year. And if you are an additional rate taxpayer, that means you earn over £125,140 a year, then you don't get an allowance. So the person who is in the high rate tax band, that's if you earn more than £50,271 and less than £125,140.
And on that, is it a sliding scale, or is it once you go over it tips over and that's it?
It's tip over, that's it. So it's not like the sliding scale of the starting rate for savings. So you can see there is actually quite a wide range of allowances that you can apply to interest on savings accounts. So let's say, for example, you were somebody who didn't have any other income, but you had lots of money in savings, maybe you're retired. You could take, for example, over £18,000 a year tax-free if all of that income came from your interest on savings. And on top of that, technically, if you were married, you can then also use the marriage allowance, transfer some of your partner's unused tax allowance if you wanted to do that, to increase that further. And of course, they have their own allowances in terms of the personal allowance starting rate for savings and personal savings allowance. So that gives you just a bit of a whistle-stop tour about how things are taxed. So for a lot of people, they won't be paying tax on the interest they get on their savings.
And as you say, Damien, that was a whistle-stop tour, but we do go into it in a lot more detail in some articles that we have on the Money to the Masses website, including the personal savings allowance and also the marriage tax allowance, for example. We'll put links to all of those in the show notes.
So the reason why I'm talking about this now, and it's particularly relevant, is because let's say many of our listeners may earn the average wage in the UK, and therefore they are using their personal allowance against their wages, and therefore they don't get the starting rate for savings because they're earning more than the £17,570. They therefore, if they're a basic rate taxpayer, they will only have the £1,000 personal savings allowance. Well, at the moment, you can relatively easily get 5% interest on savings because interest rates have gone so high thanks to the Bank of England raising the base rate. So you only have to have about £20,000 in savings to earn around £1,000 a year in interest. Now, if you're a 40% taxpayer, I'm talking about income tax, your savings allowance is only £500 a year. So you've already begun to the point where you're paying tax. My point is, we're not talking about ISAs here. So money in ISAs is tax-free. We're not talking about premium bonds. Money in premium bonds is obviously tax-free as well. Anything you get from that, the prizes, is tax-free. We're talking about the savings you have in ordinary savings accounts. So for more people, they're going to be starting to have to pay tax on the interest that they are now earning. So what do you do about that? Because they're in a world, for many people, they've never been here. To explain what happens next is that you may not realise that your bank and building society are actually reporting the interest that you earn to HMRC. And they even report it even if you're not earning enough to pay tax. So if you're earning an amount that's less than your savings allowance or your personal allowance, they tell HMRC what you're earning. They also tell HMRC whether it's a joint account, because don't forget, any interest earned on a joint account is split in two. It's deemed to be 50-50. So one of you has earned half the interest, the other person's earned the other. So it's taxed in that way.
So this is all happening already in the background, not necessarily even without our knowledge. It's just something that technology and the fact that a lot of stuff now with HMRC is done online, these two things are marrying up without your knowledge.
Yeah, so they're occurring in the background. This is why people listening to this may not have paid into more than one ISA. I know the rules are changing, but people who are paying into more than one ISA in a given tax year, this is how they find out. This is why you get a letter from the taxman, effectively, HMRC, to say that you are paying into more than one ISA, don't do that again. And so this is all being reported. So they have a record of what you're receiving. Now, you don't have to worry if you are, for example, employed, so you're getting paid by a PAYE, or you're maybe receiving a pension, because don't forget, if you get a pension from like a private pension, for example, or a company pension, that is paid via PAYE, so tax is deducted from that. Then what happens is your tax code will be adjusted in time to reflect the tax you should be paying on your interest on your savings. So you don't have to do anything. And the reason why this is probably interesting to people, because in the future, now we're at the world where people are now earning enough interest to warrant paying tax, they're going to notice their tax code is going to start to change, possibly. Now, the one quirk of this system is that, let's say you have a tax year where you have earned, let's say this tax year where people are earning a lot of interest, so they're getting 5%. And so let's say they breach the levels and they're going to end up having to pay tax on the interest that they've earned. So we're coming towards the end of the 2023-24 tax year. What will happen is that the reporting about the interest that you've earned doesn't occur until this summer. So the summer of 2024. So what will happen is your tax code will change from April 2025. And so therefore you'll be having that adjustment throughout that whole tax year. But if you think about it, you're kind of having an adjustment, paying tax in 2025 to 2026 tax year for interest that you earned in the 2023-24 tax year. So there is a big delay. So in the future, if your tax code changes and you're wondering why, one of the reasons could be because of the interest that you earned in a period like now where interest rates are high. Now, the one other issue that there is with this is that the HMRC actually dictate your tax code. Your tax code will be based upon the expectation of what you were earning in terms of interest in previous years. So it could mean that people will see adjustments going forward in their tax code and they not realise why, and they're actually not earning anywhere near as much interest as they had done previously. Let's just say the base rate gets cut, savings rates go down. So do be mindful, keep an eye on your tax code going into the future, because this could be one of the reasons why things have changed. So if you are somebody who isn't paid under PAYE, then the way you change or you pay tax is through self-assessment. So you will be using self-assessment anyway if you already registered for it. If you earn more than £10,000 interest in a given year, you do have to register for self-assessment anyway. Even if you are under PAYE, you've got to declare it. And so that will mean there will be people out there who are lucky enough to have £10,000 a year in interest that they're earning. They will need to register for self-assessment. So the reason why this is obviously relevant is because we're coming towards the deadline, which is the 31st of January every year, where you have to do your self-assessment online. If you haven't done it via the post and registered that way in the October, you have to do that by this January. Now, this January, so I'm talking about as I do this podcast 2024, this self-assessment relates to the previous tax year, so 2022 to 2023. So a lot of people probably wouldn't have earned anywhere near the interest rates then because rates hadn't gone high by that point. But savings rates have gone high this year. So when we get to the end of this tax year, just be mindful, look at what you've earned. You will be sent statements by your banks and building societies, so you can download them online for your annual interest rates. Do bear that in mind that you may have to end up either doing a self-assessment, declaring it on your self-assessment next January, 31st of January 2025, or you might start seeing changes to your tax code. And the other thing I just want to mention, it can be that you think you've paid too much tax. Well, if you're doing self-assessment, then you can make changes in your self-assessment to allow for that, or you can actually reclaim tax via something called an R40 form. And the other thing I just want to mention, there are a lot of people who are taking out fixed rate bonds. So they might have a 1 year, 2 year, 3 year, 5 year fixed rate bond. You only pay tax on the interest in the year that it's received. So if you've got a 5-year bond, you don't actually pay tax this year on the interest that's accruing in that product. You do it at the end of the 5 years. So you are going to have a bumper payment of interest when it matures, and that will be all taxed in that particular tax year that you receive it. So the final thing, it's just a reminder really that ISAs are a powerful way of keeping your money within a tax-free environment, and therefore HMRC not obviously taxing the income. So there've been many years where people started saying, the personal allowance, why bother with cash ISAs? And all that time I maintained that no, they are still useful. Building up your ISA pot with your allowance each year, because don't forget the ISA allowance is a use it or lose it allowance. You can't carry it over. This is the world now. If you've been doing that, you're benefiting from it because you've got more of your money locked away in things like ISAs. So it's just a reminder now, taxation on savings, it's starting to impact more people, and there are things you've got to watch out for.
Okay, so let's move on to the next piece of the podcast then. We're going to be talking about national insurance and the recent cut that's happened to Class 1 national insurance contributions for the employed. So around 27 million people have been impacted by this cut, where Class 1 national insurance contributions have gone from 12% to 10%. So what we'll do is I'll explain around about how much that's going to save people based on various different earnings bands so that people can understand exactly what this actually means. So if you're in the earnings band between 12,570 and 50,270, that's where the Class 1 national insurance contributions are based. And because it's been cut by 2%, we can actually go through some numbers here and see what that actually means. So someone on a £20,000 salary is going to be about £150 a year better off, around about £12 a month. Someone on a £35,000 salary, that's near the average earnings in the UK. They're going to be almost £450 a year better off, which equates to about £38 a month. And then moving right on up to £50,000, it's around about £750 a year savings, not savings, it's around about £750 a year better off that person will be, and that equates to about £62 a month. Now, that's where it kind of caps at, because again, Class 1 national insurance contributions are charged for earnings in that band between the 12,570 and the 50,270. So £62 a month is kind of the maximum you're going to be better off every month thanks to this insurance cut.
And so I'm just looking over your shoulder there, your numbers, Andy, and you also worked out, interestingly, what that meant as a kind of percentage increase to their take-home pay. And I'm looking there, broadly for the lowest bands that you mentioned, or lowest wages, I should say, that you mentioned, it's about 0.75%, and the higher end, it's about 1.25 or 1.3%, something like that, depending where you are, actually up to as much as 1.5%. And the reason why that is interesting is because this goes back to last week's podcast in the circular way, doesn't it? In terms of the 1% difference, if you make those small incremental changes of 1%, then the impact that it can have. And this is obviously a round about 1% saving that people are. They're going to be 1% better off. And then this is where you came up with the idea for this part of the podcast, actually, which is doing something useful with that 1%.
Yeah, exactly. That's it. And just to reiterate, this has happened from the 6th of January. So people will be probably looking out for their pay slips, just to be mindful that depending on how your payroll do it, you'll probably not get the full effect in January, because most payrolls run from the 1st to the 1st or the 25th to the 25th. So have a look at January's. You should see a little bit of a difference, but really from February onwards, that's really when you need to look at the take-home pay in the bottom right-hand corner normally of a pay slip, and that should tell you what it will be going forward. Obviously, if your salary fluctuates every month, if you're on commission or bonuses, then it's going to be a bit more difficult, but just be mindful that roughly those amounts that I read out earlier, that's what you're going to be better off. Before we move on to what people could do with this extra take-home pay, let's just quickly cover off what's happening for self-employed people, because there is some good news as well for them, albeit they have to wait a little bit longer to benefit. And so there's been a cut in Class 4 National Insurance contributions, and that is charged very similarly to the Class 1 contributions. There's a band. It's charged on annual profits of the self-employed between £12,570 and £50,270. So if you're a business and you submit your accounts and you make a profit of between £12,570 and £50,270, you are charged a percentage. Now, it was previously 9%, but from the 6th of April, that's been reduced by 1% to 8%. So there is a reduction in that. And the interesting thing is there is actually another type of national insurance contributions for the self-employed, which has been completely abolished. And so Class 2 national insurance is charged rather than a percentage, it's an actual figure. It's £3.45 per week. If you have profits as a business more than 12,570, there are some voluntary contributions you can make if your profits are below that, but that's now been abolished. And with that extra 1% saving people are making on the Class 4 contributions, I'll quickly go through what that means in terms of savings. And so with a reduction of Class 4 national insurance contributions and the abolishment of that Class 2 national insurance contributions, the self-employed will be better off from the 6th of April going forward. I've crunched the numbers. So if you are a business that has annual profits of £20,000, it's going to equate to just over £250 a year, £269.64, roughly £22 a month. If you're in that mid-range, the average self-employed worker who has profits of £35,000 will be better off to the tune of £426, roughly £35 a month. And so a self-employed worker who has profits of £50,000, it's going to equate to an annual difference of about £570, just under £50 a month.
So again, headline numbers, you're looking at 1% is the number that people will be looking at, how much they better off. It doesn't seem huge, but it is obviously, when you're looking at the pounds and pence, can be decent enough and significant. But then what they can do with that is makes it quite an interesting conversation.
Yeah, so I mean, on the employed side, it's roughly between £12 and £60 better off. On the self-employed side, it's between £20 and £50 better off.
A month, that's what you're talking about.
Yeah, I mean, it's an amount of money that they didn't have before. And so we looked at what potentially you could do with that money. I mean, obviously, if you're someone who was already struggling prior to this, it's going to be welcome news for you. You're going to have that extra money available each month to use as you wish. But there are a few extra things you could consider doing with the money. I mean, first of all, to cover off the fact that if you were in debt, then it wouldn't be a bad idea to use this extra money to pay off debt. For example, if you've got a credit card and you're used to just paying off the minimum each month, it would be a really good idea to get in contact with that card provider and up that minimum and include this amount extra you're getting and fix that amount each month.
Yeah, and especially if you're working towards a budget, you've got budgeting apps, you've got budgets. This is money that you weren't expecting you could add to it. This is taking the principle of, if you get a pay rise, that you use the additional money and you still maintain the current lifestyle that you have, but use that additional money for other purposes. And this is just taking that concept. Yeah, the government's giving you this extra small increase, but you could use it, like Andy said, to pay towards debt, which could have a significant impact over the long term, assuming, of course, assumptions that the saving will remain and it won't change in the future, or we won't have a change of government, etc., etc. But at least for now, this is an increase that people weren't expecting.
Yeah, a really good way to use that money, paying off debt. We use an example in there, and I'll link to it in the show notes, where if you have a £3,000 credit card and you're only paying the minimum, it would take 19 years to pay that off. So we've covered off using the money if you need it. We've also looked at potentially using that money to pay down on debt. You could also use this money, extra money, to build up an emergency fund if you haven't done so already. So an emergency fund is a financial buffer that you can use to help combat those nasty surprises. If the boiler breaks, for example, if the car breaks down, rather than having to potentially find borrowing for that, a credit card or a loan, you can dip into that emergency fund. And it's a good idea for everyone to consider having one of those if they haven't got it already.
Yeah, and you could even just put it into savings generally that you might have access to. You could put it towards something maybe for Christmas next year, because the people who are employed, like you said, Andy, they're going to have around about 12 months of this. Not quite full 12 months, but they're going to have a significant sum that could be built up. Let's say you have managed to save £50 a month via this, then obviously you're going to have some heading towards £600 by the end of the year. Of course, there are other things you could invest it. You could do things for put it in children's accounts, junior ISAs, etc. But obviously that's all with the caveat that you can't get the money back out of a junior ISA. It's for the child's benefit, and you won't be able to take it out in most circumstances until they are 18. Well, they won't be able to because it's their money. But you could put it in, for example, a easy access account if that's what you wanted to do to get a better rate of return. There are regular savers out there you can get now which still pay 8% interest, which is where you put a regular monthly amount, like £50, for example, into the account, and they give you an interest rate that's equivalent to 8% a year. So they are ideas. I mean, you've got one or two others as well.
Yeah, so an interesting consideration is you could actually use this extra money to plug any gaps that you have in your national insurance contribution record. So you're kind of using the cut to national insurance to boost your national insurance contribution.
So if you've got missing years, so people can go and get the state pension forecast. So you can go and do that. It's free. And if you did have gaps, like Andy says, then you could use that money to try and fill in the gaps from past years. We'll put a link in the notes actually that explains how you do that, how you check, and how you could potentially plug any gaps. It won't be everybody, but there are some people who may have gaps in their record. They may have, for example, not worked for periods of time or something like that. Then they could use this as an idea to plug the gaps.
Yeah, and where it's particularly exciting, for just £800, you could plug a full year's worth of national insurance, which will boost your state pension by £303. But that's per year, so you only have to be drawing a state pension for 3 years to make back the money you've put in, and any money after that is extra money. Yeah. So, I mean, if you live for 20 or 30 years after your state pension age, it's money well spent. And the final thing I want to discuss on the pod is consider putting this or diverting this extra money that you've got into your personal pension, because straight away you're going to be getting an extra boost from the government because you get tax relief on the contributions.
So, for example, you put £40, let's say the same as £40 a month, you put £40 a month in your pension. That would actually, assuming you're a basic rate taxpayer, that would actually equate to a £50 amount going into your pension gross once the tax is claimed by the pension provider. So it is a way of topping up your pension as well, which obviously can have a big impact over the long term.
Yeah, I've crunched some numbers here. Someone who's 45, for example, and there's a lot of assumptions that this money is going to continue. Let's assume it does, and you regularly put that money in each year, assuming a 5% growth. Very, very round numbers, but just to get you excited, by the time a 45-year-old turns 67, it could be an extra £50,000 that could be worth.
Brilliant. I love that piece, Andy, because it takes the idea of something that's happening, and it's those small incremental changes which have come about. We talked about it last week, the one thing to do different, making the 1% difference. It's almost wonderfully circular that the following week we've got examples of a 1% difference can have a big impact on lots of areas of your finances, and it's an amount of money that has effectively that was unexpected. So it's come from nowhere really for a lot of people. So good piece, Andy. I'm going to move on to the final piece of the podcast, and it's about doing things differently. Kind of links nicely to what you're mentioning there in terms of looking at things and doing it slightly differently. For example, you mentioned there about the fact that you are using that money to try and make those incremental changes. That is almost like saying that you're going to do something, not live to your means, which is something that we all do regularly. And the reason why I mentioned that, and it leads into this part of the podcast very nicely. Last week I talked about making those incremental changes, and we often talk about on the podcast about how you can build for your financial future and things you can do. Now, there is another element to this that we don't always talk about, but it's about how you reflect upon what you've done in the past. So the new year is always a time where people reflect backwards, and I'm talking about in their personal life, not just money. Actually, most people don't reflect back when it comes to money. They tend to look at it about what's happened in their relationships and things like that, and that almost spurs them on in some way to try and make a change. Now, I think it's important that people try and use that same reflection, but to look back at their personal finances. Now, there are a host of things out there that you will see where people talk about ways of doing this, but I want to just keep it fairly simple. So what I wanted to do was take this idea and give some examples about how people could do this to go forward. And the aim is to try and increase your chances of success in the future, because the issue you have, you can try and make changes and perfect what you're trying to do going forward, but if you've still got behaviours that cause you not to achieve what it is that you want to achieve, then it's a bit like driving a car while pushing the brake and accelerator at the same time. And sometimes you might want to look back and reflect and say, yeah, that was something, that a behaviour that I exhibited that meant that I didn't achieve what I wanted. So an example could be that you look back on your past year, and you may look back and say, right, how much did I earn last year? And what were the things that influenced how much I earned, how much I didn't earn? And you might want to look at that. Some of that could be down to your career. It could be down to the way you look at things in terms of maybe there are certain qualifications you can take. But more importantly, you're looking at in terms of pounds and pence, money that was coming in. And look at your expenses that were going out. And so budgeting apps work brilliantly for this, because what they do, and I don't think a lot of people use the backward looking part of it, because a lot of apps, for example, like say Money Hub, they will all allow you to look at your past budgets for different months and see where you're spending, if you're overspent. Because what happens, you get to the end of the month and you suddenly clock onto the new month and you've got new budgets and you kind of forget the previous ones. What I want you to do is go back and flick through those apps, because even if you download them now, they do tend to categorize back. I think normally it's about 3 months. They do categorize your spending habits. And the reason why looking back and reflecting upon it is you can reflect upon the months where you succeeded in living to your means or keeping to budgets, and the ones where you didn't. And then go back and try and identify what were the triggers that caused you to adhere to your budgets or to bust them. And an example of my own personal finances, I've worked out by looking back at these things that if I try and keep a slightly tighter ship in the first 2 weeks of a month and not just get to payday and go for the blowout, which is what everyone feels like doing, it doesn't mean I'm necessarily limiting myself, but try and manage that. Then by the end of the month, I am much more likely to succeed in my budgeting, because I will spend more than I did in the first 2 weeks, but I am more likely to I'm not likely to blow it out. And I can see that because they draw charts and they can show you where your line is month to month compared to the previous month when you're looking at your discretionary spending. So by looking at the analysis, you can start to see what are the drivers in terms of your success or your lack of success. Now, one of them, the word Amazon is like, it's like kryptonite to any budget that I have. So Amazon is one of those retailers where things are so easy that they're constantly looking, and it could be like £5 comes in today from Amazon. You're buying things off it all the time, things that we need as a family. But if I didn't use Amazon as frequently, because of the lack of resistance when you're purchasing anything with Amazon, it makes it too easy. But if I didn't use Amazon, I probably would save a lot of money anyway, because I wouldn't be buying some of the things I probably would make do, or the friction there would probably help me not spend as much, because it's all too easy just to press a button and buy things on Amazon. So I know that if I really wanted to rein in my spending, probably looking at what I buy or what we do as a family on Amazon would be one of those things. And I think the other thing is to look at your savings and investments that you have, how much you've put in, when you succeeded in putting as much as you wanted, when you didn't succeed. You can look at your investment returns, what drove the returns. Was it your behavior in terms of when you bought investments or you sold out, or when the market dipped, did you sell out rather than stay in? Look at what the market did versus your own investments. And it's only upon reflection that you can look at what needs to change or what doesn't going forward. Because one of the things you need to do is also pat yourself on the back for decisions that were made. So a very good example was recently I had somebody write to me talking about their investments, and they were looking at their investments and said, well, I think they had an okay year. They were like, well, I was up about sort of 5%. And was that good or was that bad? Now, of course, if you look at some of the indices out there, they rallied very strongly. But what they failed to actually look at was over the 2-year period since beginning of 2022 and throughout that period where the Ukraine war was raging and the market initially slumped, they had broken even over 2 years of investing, yet nearly every index you look at, they are still down because they're trying to recover the dips of 2022. So there is that acknowledgement and gratitude of the things you've done successfully over a period of time about the decisions you made, which was to stay in the market or to invest in a certain way, hold certain investments. And that is important because sometimes you can look at things and review them and just look at the headline number and not realize what was going on at that point in time. So when I looked at it and said, look, at this point, you were down 2%, the market was down 15. That was brilliant. And then you appreciate what you're doing the right thing, you stick by. And so therefore, by reviewing and reflecting, you try and keep those behaviors, because what will happen, we'll have another market sell off and the knee-jerk reaction is to panic and sell out. So go back, reflect how you felt about different things at different times, reflect about, like I said, your income, your expenditure. Of course, debt is always going to be a big one. How did you manage debt? Did you manage to keep it under control? Did you go through periods where you struggled? What caused the trigger for you to struggle? When you were spending, did you spend more? For example, were there months where you maybe spent more on takeaways that were the things that was the common thread that meant you didn't budget? Or did you have too many nights out with friends in 1 month? And is there something you can make a decision that can increase your chances of succeeding?
Yeah, that's interesting. Reviewing the debt spiral is actually quite a good thing to do, because I imagine that most people's reaction is to bury their heads in the sand, not look at that statement where it all went wrong that month. But actually, you can learn a lot from that. And the bigger thing is to look back and go, okay, I understand what happened. I now understand why it happened, and I can make sure it doesn't happen again. Or at least if I can recognise the signs of it starting to happen, I can nip it in the bud quicker.
Yeah, and if you go back to our Black Book episode that we've done, and we'll put a link in the notes, which was all about, I think it was last year, we did a 28-day challenge, which was trying to sort people's finances in 28 days. The core part of the first stage was to put down everything about your finances. And part of that was about owning it. And that part of the process was called Own It. And it was about owning, not just about your finance in terms of physically what do you have, but it was about owning where you are, and then even the mistakes that you've made, the amount of debt you have, because it isn't until you see that in black and white and face up to it that change will happen. People, for example, won't go back often and don't know how much debt they've got because they don't want to face up to it. That's why you have to go back and see what's going on, look at the mistakes we've made, own those mistakes. We all make mistakes, but it's only by doing that that you can then work out that, yeah, that was a mistake I made last year. I'm going to try and change that. Some mistakes could be things that possibly that you spend too much money on going out drinking or gambling. These are things that are painful to face up to. If you face up to them, they increase your chances of obviously happiness, well-being, but also financial success. But then that then leads on to the fact that you do need to do the gratitude part. You do need to sit down and be thankful for, if you've had a steady income for the year, the successes you've had, like, for example, putting money in your pension or saving for your future. It may not be as much as you want. It may be more than you want. But those successes, maybe you've managed to cope with your mortgage rate going up, and you need to give yourself a pat on the back for that. And the reason why that's important is because it gives you a positive mindset. So you go into the next year, this new year, with the idea that I can cope with what the world throws at me. And that was one of the things I said to people at the end of 2022 when I did 80-20 Investor. And we did, obviously, people would have largely had a very good year compared to the rest of the market. My portfolio did. But it was more at the end of the year was the message was to say to people, you've invested through the hardest year possibly on record, and you've come out the other side pretty much unscathed. That is something to be proud of, but take with you going forward, because hopefully things can only be better than that year. Then that leads on to the fact that obviously you can then start setting goals, because if you want to change your behavior, it may be you say, well, I want to save a little bit more into my savings. I want to build an emergency fund. And those things are like we were talking about last week about the 1% differences. You can start doing things like increasing your contributions by 1%, or maybe it's £50 a month. You might decide to try and increase the amount you pay off your debt each month. You might decide to stick to a budget more and follow it a little bit more. These things are all goals that you can set, but you really can only set realistic goals, I think, if you know where you've come from, because you could end up setting goals that are way too optimistic. This is an incremental process. Don't forget, if you do this next year, you hopefully would have had a bit more success. That incremental improvement, then the goals you set next year will be a bit more ambitious than the ones you set this year, because you're trying to move forward. So I do think it's important to reflect. It's important to look at the mistakes, the successes you've had, and allow that to inform you going forward, to give you a bit of a positive mindset. And also, I think it helps you manage the stresses around money. So it could be that you then decide, look, I didn't review my finances regularly enough. That was one of the things why I didn't succeed. I didn't use, maybe it is a budgeting app, maybe I didn't review my finances every few days, every week. And then by changing that behaviour and going, I am going to sit down and talk about money with my partner, because do you know what? That was one of the things we didn't do, and I think that was one of the reasons we perhaps didn't succeed. Or one of the reasons we did succeed is we were more open. We're going to continue doing that into this year. Have a look, see if you can come up with any ideas, try and change some of the behaviours in the past that have been limiting you. It could be even the simple thing as the way you view things, talk about things. It could be things like your view on how you use debt, the way you use it. Is it something you rely upon, or are you going to stop, for example, using it to buy things that are perishable? That's something that lots of people do. You might decide, I'm going to change that and only going to buy things now that are things, I'm not going to buy my lunch on credit. I'm going to end up buying things that I need, use it more for the cash flow. Trying to make changes by reflecting on the things you've done in the past, I think is important, and it will increase your chances of success.
Okay, so there we have it. We're done for this week. If you want to get in touch with Damien, you can do so in the usual ways. Damien at moneytothemasses.com. Don't forget that this podcast does go out on YouTube, and that's probably the best place right now to contact us and put any questions that you have or any comments about this particular show, because we will be able to go in there and answer those questions.
Nearly forgot, Andy. There was something important that happened at the beginning of the show that we should have talked about. And that is the new quiz that occurs on a Monday.
Oh.
So on Instagram this week, we put out a quiz that was multiple choice questions on the podcast. I think there were 4 or 5 questions about the content that's on the quiz, to basically test to see if you're listening and learning. And we can see what people answer, and people can tell us what they got. So it's a bit of fun, but it's really just to try and reiterate some of the things that we're teaching people on the podcast. It's on Instagram, it's on our stories on a Monday, so make sure you check that out and then let us know what you get and if you enjoy it. It seems to have gone down a storm. People like a test.
They do like a test, and I'm now wondering whether you and I are going to get 100% every week, because we better.
I did do the test last week. Actually, I did create the test, but if there's a week I didn't get it.
Actually, we shouldn't call it a test. Let's call it the quiz.
The quiz.
That was my fault. I called it a test. The test puts too much pressure on our listeners.
Like we said, it's all about language. Yeah. So a quiz is fun. A test is something that takes you back to being at school. So yeah, do go and have a look at the quiz on a Monday. It's something I think we're going to keep, because I do like it. It's again reflecting on what you've learned. So I do like that part of it.
Good stuff. So we are done for this week. Make sure you do review the podcast if you can. 5 stars always helps. Just go to your podcast app of choice, pop the details on there. And if you want the chance to win a Money to the Masses mug, just make sure that you email us to let us know that you've done it and claim it. And we'll be happy to send one out.
Yeah. And so that's it. So until next time.
Till next time.